Hello and welcome to all of you who were able to come and participate with us today. We're really excited about the opportunity we have to give you a few updates for GAAP accounting reporting, and also we've thrown in some tax information as well in our presentation today. So might just give it another minute or so to let a few more people get logged on. Thanks again to everyone for being here. We'll just give it another minute or two. All right, we're going to go ahead and dive in. Next slide, please. So we'll start with some housekeeping items for y'all here. We appreciate everyone being here and giving us a chance to share some knowledge with you, and hope you find some helpful information today in the presentation. The presentation will be recorded and will be available on our website after the conclusion of the presentation. And just our little disclaimer, if you will, we're presenting information as it stands today. And as always, information can change in the future. So just wanted to remind you of that. If you do have questions during the presentation, you can click on the Q&A button at the bottom of the screen and then enter your questions through that window. We have turned off the chat just because there's a number of people participating today, and the Q&A feature just helps the presentation flow a little bit better when we use that. We also have turned off the hand raising and anonymous questions. So just for your information there, use the Q&A. We will, between presenters today, try and answer a few of the questions. We also have left time at the end to be able to go over your questions at the end. So we'll try to get you to your questions today. If not, we can always circle back with you later. All right. So we also are offering CPE for this webinar today. In order for us to provide that CPE, we are required to have what's called like an attendance check. And the way we've done that in this presentation today is through polling questions. So you will need to respond to each of the poll questions. So that way we can keep record of those attendance checks for the purposes of CPE. Another requirement for us to be able to offer CPE for this presentation is we need you to submit evaluations of the presentation, and for each presenter individually. You will receive an email after the close of the webinar with links to the evaluation surveys, and we really appreciate your feedback there. And also that submission of feedback of evaluations allows us to be able to offer CPE. The CPE certificate, you can expect to see that via email within a 2-week time frame. We just need some time to double check attendance and this evaluations, and then we can get those sent out to you. Before I move on, does anybody have any questions about CPE? If you do, again, you can submit it through the Q&A button there at the bottom. Okay. We'll go through today's agenda. First up, Cameron Hodson will be giving us an overview of relevant GAAP updates. There's a lot of GAAP updates and recent pronouncements. There's always a lot going on, but we've tried to find those items that are going to be the most relevant for captive insurance companies. That's what Cameron will focus on that. And then next up, you'll get to hear from me. I'm going to talk through ASU 2016-01, that new reporting update for equity securities. And then Tanner Larson will give us an overview of alternative investments after that. And then we'll get to hear from Jason Parker, and he's going to go over that new IRS Form 1099 NEC and some of the ins and outs there. And then, as I mentioned, we will leave time at the end of the presentation to go through questions that you all have submitted that maybe we didn't get a chance to answer, either just by one of the panelists being able to answer your question through the Q&A feature, or if it was just something we wanted to save to the end because it was an important question we wanted to talk through. So with that, I will go ahead and turn the time over to Cameron Hodson for his portion of the presentation.
Thanks, Diane. Appreciate that. So I'm going to be talking about a couple recent GAAP updates. And as Diane mentioned, the list of proposed and adopted ASUs is pretty long, but we've boiled it down to just 3 today that we're going to cover that we think apply to the captive insurance subset. If you're interested in more of these updates, we encourage you to go look at our blog on our website, larsco.com. But the 3 that we're planning to cover today, the first 2 kind of go hand in hand. I'll be talking about CECL and explain the acronym there in a minute, and then a little bit about the fair value option, and then some changes in some fair value leveling disclosures. Next slide. So the first one that we've heard a lot of talk about initially this is part of 2018-13 and then pushed back with 2019-10. And now this is scheduled to be implemented for private companies for years beginning after December 15th, 2022. So again, this wouldn't affect your reporting until 2023, audit in 2024. So a couple of years down the road, but there are some things to think about now as far as gathering information for this standard in order to be able to implement it. CECL, this acronym comes from current expected credit loss. It's become the common term for this standard. And this changes the way that we're looking at potential credit losses in the company's investments. We've summarized here current GAAP. The standards are that we delay recognition of credit losses until they become probable, whereas the new CECL guidance is to take a snapshot at the reporting period of an estimate of credit losses. So not to wait until it becomes probable there. And 2 definitions here of expected credit loss, and which one of these you apply tells me whether you're a glass half full or half empty kind of person. So the first one is an estimate of contractual cash flows not expected to be collected. The second is cash flows expected to be collected. And so the difference there is just whether your calculation in the first scenario, your estimate is not expected to be collected, then that's the amount of your allowance. We'll talk about that in a second. Second scenario, expected to be collected, is your new measurement point that you'll write your asset down to, the difference being the allowance. And we'll look at those measurement points here in the next slide. So there's definitely a lot of details in the CECL guidance. And as I mentioned, we have a couple years to get ready for that. We're not going to be showing any journal entries per se in this training, just to give you kind of a high level what to expect. So with that, a couple measurement points that will occur. I mentioned an allowance account. This will be presented as an allowance on the balance sheet, netted with the related financial assets. And measurement point 2 there is this is at the reporting date, just whatever period your financial statements are representing. And then the offset to this allowance account will be flowing through net income. Next slide. Pretty long list here of assets in scope, not in scope. You're welcome to read through this list. Good luck doing so before I get to the next slide. Basically, any financial assets that you may have and that may have a fair value, may have a credit loss component, you could apply this standard to. You'll notice in the not in scope category, if you're researching the standard, available for sale debt securities I've highlighted here. When I first thought of CECL as it applies to captives, This is probably the main category that you'll see your financial assets fall under, that this standard applies to. And a lot of the resources say it does not apply, and that's because it's kind of a unique component that that 2018-13 clarifies at the end of the standard, which is that there's going to be now two components to the available for sale debt securities. You'll have to bifurcate the interest rate loss and the credit rate loss. And any losses related to credit risk will go through the income statement and apply CECL, and the interest rate will still go through the OCI, like your available debt did in the past. Okay, next slide. So the first polling question here is, what categories or category of of assets do you expect will be affected for your companies? So pick all that potentially apply. I'll give you just a minute to answer this. Okay. Can we show the results of the poll? Okay, so a good representation here, it looks like. And as we continue to talk about this standard, maybe you'll think of some others where this may apply. Next slide. So moving a little away from CECL, but still in the same area, for those companies that anticipate quite a burden from reporting under CECL, there is some transition relief. And one of those is the fair value option. And this will allow any of those financial assets that fall under the scope of 32620, which is where CECL is going to live in the guidance. You can choose instead to apply the fair value option. So instead of the estimations for your current expected credit loss, which is kind of a future cash flow perspective, using one of the CECL methods, you could instead use this fair value option and look at fair value sources, and that would measure your asset up or down at the reporting date with those gains or losses flowing through the income statement. So it's still affecting your income statement, but perhaps a little bit less onerous as far as tracking and calculations. Okay, next slide. Okay, the last issue that we want to talk about today is a few changes in the fair value measurement disclosures. And this will make probably the most sense when we put it together. A few of these disclosures have been removed, and then we'll look at some that have been modified, and then lastly, some that have been added. I've grouped these into three categories for you today, and we've got our level 1 and level 2 disclosures lumped together because those have kind of been treated similarly. Level 3 investments, and then NAV. I've included NAV. This is assets that are measured at net asset value per share, because those are considered in the standard, and they'll appear, if you're your financial statement footnotes, they'll appear in your totals column when you're looking at your leveling, but they won't appear in one of those leveling categories, level 1, 2, or 3. So a few things that have been removed, I'll let you kind of read through these, but amount and reason for transfers, level 3 evaluation process. Let's go to the next slide. We'll look at these put together for a little bit longer in a second. So modified For level 3, we're no longer doing a roll forward, just looking at transfers in and out, purchases and issues, and net asset value per share, looking at those redemption requirements might lapse. A little bit of clarification there. Let's go to the next slide. And then added disclosures, nothing in 1 and 2, nothing in NAV, just the level 3. Now we'll have to disclose weighted average unobservable inputs used. And if you go to the next slide, you can see, next slide, please. For level 3, we've noted that added is now we're disclosing changes in unrealized gain or loss that go into OCI instead of previously it was changes in unrealized gain or loss that were included in earnings. So kind of just a different focus there. And yeah, so that's about it for the fair value measurement. I will note that we haven't seen a lot of movement in the captives that we've audited with you in these levels. So for the most part, I don't expect this to have a large impact either on your captives. Thank you.
All right, thank you, Cameron. We did not have any questions come in specific to your presentation per se, but we did have questions that it looks like people were not seeing the pop-up for the polling question. We're checking to see if that's something on our end, or maybe potentially if there's something on your end where you may need to enable pop-ups, but we're checking into that. Don't worry if you weren't able to answer that polling question. This webinar software also keeps a record when people are logged in and if they log out and log back in and things like that. So we have that as a backup for your CPE, just in case the polling isn't working for you on your end, that it looks like people are not able to potentially answer or something didn't pop up. So we're working on that in the background. In the meantime, like I say, we have other records of attendance that we can rely on for CPE if by chance that polling pop-up is not working for you. So with that said, I will move on to my portion of the presentation. So we are going to talk about ASU 2016-01 financial instruments. So next slide. First, just why the new standard. So before the global financial crisis that began in 2008, both the FASB and the IASB began a joint project to improve and to achieve convergence of the respective standards on the accounting for financial instruments. So when that global financial crisis happened, it just further highlighted the need for improvement in the accounting models for financial instruments in today's complex economic environment, which is even more complex right now, right? But as a result, the main objective in developing this update was enhancing the reporting model for financial instruments. Next slide. So the effective date. So here, this could be, I guess, either good news or bad news for you. The good news is that it's already effective. So if you already implemented, then you don't need to worry too much about this. But the bad news is that if you didn't implement yet, you're late to the party. So the effective date for private entities for this update was for fiscal years beginning after December 15, 2018, or 2019 calendar year, and is another way to look at that. And then also just keeping in mind interim periods within fiscal years beginning after December 15, 2019. And then the effective date for public entities was the year before that, basically calendar year 2018. Next slide. All right, so now I'm just going to move through the main provisions. There may be a few other provisions in the standard that I don't highlight here in the slides, really just because they were not going to be applicable to anything that you all are seeing day to day on a captive insurance company set of books. But that's my little disclaimer that there might be a little bit of additional information in this update that we don't cover today. So the first main provision I want to make sure you're aware of is it requires equity investments except for those accounted for under the equity method of accounting or those that result in consolidation of the investee. So outside of those, equity investments must be measured at fair value with changes in fair value recognized in investment income in the income statement. Next, just making sure you note that an entity can choose to measure equity investments that don't have a readily determinable fair value at cost minus impairment, if any, and then plus or minus changes resulting from observable price changes in orderly transactions with an identical or similar investment of the same issuer. So there is also that option that you can measure equity investments at cost minus impairment. So just keep that in mind. That is an option. The next provision, item to note, important thing to note, is only debt investments are classified as trading, available for sale, or held to maturity in the balance sheet now. So anything other than those debt securities, those classifications, those three classifications you're used to hearing about and seeing, are no longer applicable. Next slide. All right, so a helpful thing that this new update offers is they've simplified the impairment assessment of equity investments without readily determinable fair values by requiring a qualitative assessment to identify impairment. Maybe before it was solely quantitative, but there's also qualitative information to be considered, that this simplified things there. When a qualitative assessment indicates that impairment does exist, an entity is required to measure the investment at fair value. So whatever inputs you have, the observable inputs you have to help make that measure of fair value, that would be required. And next, this update eliminates the requirement to disclose the fair value of financial instruments measured at amortized cost for entities that are not public business entities. So before, if you had held to maturity bonds that were at amortized cost, you still had to disclose the fair value of those bonds, for example. And now for private entities, that disclosure requirement has been eliminated. So that's helpful. One less thing you have to worry about. All right, the next item is there's now a requirement for the entity to present separately in other comprehensive income the portion of the total change in the fair value of a liability resulting from a change in the instrument's specific credit risk when the entity has elected to measure the liability at fair value in accordance with the fair value option for financial instruments. So this is one that, again, I think this will be really rare on a captive insurance company's set of financial statements, that you have a scenario where you have a liability that's on the books that you would want to elect the fair value option for. So again, I think this will be one that you probably won't see, but we wanted to make sure that you're aware of that provision of the update. Next item is this update requires separate presentation of financial assets and financial liabilities by measurement category and form of financial asset. That is, if it's a security or loan and receivable and this is on the balance sheet, or you can do it in the accompanying notes to the financial statements. And a little bit later on in my presentation, I have a sample set of financials and footnotes so that we can kind of walk through what that will look like. And then the next provision clarifies that an entity should evaluate the need for a valuation allowance on a deferred tax asset related to available for sale securities in combination with the entity's other deferred tax assets. So again, this is just a clarification here. This is something that we all are probably doing anyway. We know that when we are marking an asset to fair value on the books for GAAP purposes, that is going to generate a book tax difference that then needs to be accounted for through a deferred tax asset or liability there. So just remember that those available for sale securities do need to be, the valuation allowance on a deferred tax asset there does need to be looked at and evaluated separately. All right, next up, it talks about what you do when you implement the standard. So Any adjustment at the adoption as update will be made by means of a cumulative effect adjustment to the balance sheet as of the beginning of the fiscal year of adoption. So to clarify that a little further, the next item talks about these amounts that were reported in other accumulated other comprehensive income for equity securities that exist at the date of adoption that were previously classified as available for sale will be reclassified into retained earnings. So before, for those equity securities that were held that were classified as available for sale, your change in fair value was running through other comprehensive income and in your equity section in your balance sheet. But that with this new standard update, when you implement that change, you need to adjust that effectively out of your beginning balance of AOCI and reclassify that or move it into your retained earnings classification. And then going forward for that year, your adjustments to fair value, your change in fair value will run through current earnings in the income statement. Okay, next slide. I think this is our polling question. All right, so which type of security is still required to be classified under the trading, available for sale, or held to maturity classifications? Is it A, common stock, B, mutual fund, C, bond, or D, non-convertible preferred stock? And if you're still having an issue with the pop-up on this polling question, please feel free to just type your answer into the Q&A. That way you can answer there if you're not able to click on the polling question on one of those radio buttons in the polling question, or if you're not seeing the pop-up, feel free to go ahead and just type A, B, C, or D there in the Q&A. We'll just give it one quick more second for people to get their answers in there. All right, good job, 65% got it right. Those bonds, you can still use those classifications in the balance sheet for bonds, but common stocks, mutual funds, and non-convertible preferred stocks are all equity securities. And I thought I'd trick people up with putting that non-convertible preferred stock in there because convertible preferred stock is actually considered to be a debt security and would still, and so it would, sorry, it's an equity security, sorry. So I tried to trip people up on that one, but all right, next slide. Okay, so for this last portion, I just want to go through a really simple example of what the financial statements and footnotes will look like once this update has been implemented. So here in this balance sheet that I'm showing you, all non-equity securities that are held as of the reporting date are classified as trading. Also, the other thing to note here is that the entity didn't hold any marketable securities in the prior year. So here, the way this was presented is all marketable securities are presented on one line item on the face of the balance sheet. Now, if you remember previously, I mentioned that you do still have to present or disclose these items by their type, be it stocks or bonds or that nature. And then also by the classification, be it equity, trading, or available for sale. And I'll show you that. We did that in a footnote a little bit later. So here is a balance sheet presentation. And again, I would show you the retained earnings section, but this entity did not have any investments held in the prior year and specifically didn't have any available for sale investments that had any unrealized gains or losses sitting in other comprehensive income. But if they did, we would also show the equity section here showing that your other comprehensive income was reclassified to retained earnings for those available for sale equity securities. Okay, next slide. Okay, here just want to talk through your footnote disclosure on your accounting policy for investments. So here it talks about the investment securities as of the reporting date consists of bonds and common stocks. And in the prior year, there weren't any held. And then just the ASC that's being followed, and then outlining that management's determining the appropriate classification of its investments at the time of purchase, and then we'll reevaluate such determination at each balance sheet date. And then here's where we're putting here in this narrative that common stocks held are classified as equity securities and that bonds held are classified as trading securities. Next slide. Okay, here on our fair value leveling footnote, you can see here these are marketable securities measured at fair value on a recurring basis. And you can see here, this is where the presentation requirement of breaking it out between both your equity securities and your trading securities, and then also within those individual categories, the actual type of security that's held. So you'll see there we've got corporate stocks listed and then real estate investment trusts listed there under equity securities. And then in that trading securities category, we've got fixed income securities or bonds there. And then that total marketable securities, that grand total of the 1.655 million, that is the number that then ties back to the balance sheet line item presentation. Okay, next slide. All right, the other disclosure requirement that I didn't mention previously is your unrealized gains and losses. Those need to be segregated and disclosed based on the classification of the securities. So you'll see here, we've got unrealized gains and losses on the equity securities broken out from the unrealized gains and losses on the trading securities. And again, that is a disclosure requirement that your unrealized gains and losses are presented or disclosed separately, that they're not aggregated in one line item there. Okay, so with that, now if there are any questions that came in or questions that we can answer at this point. Looks like we're good to move on. Okay, thank you. All right, I'm gonna turn the things over to Tanner Larson for his portion of the presentation.
Thanks, Diane. I'm going to give a brief overview of alternative investments, and I look forward to talking about this with you. So the first thing you want to do with alternative investments is look through this decision tree to determine which method of accounting you're going to be using. So the first question you need to answer is, when you purchase your investment, do you exercise full control over the investee? Which generally means, do you own greater than 50% of the investee's shares or voting rights? If you do, then you'll be using the consolidation method. If you don't, then you have another question to answer. Do you exercise significant influence over the investee? Generally, this means, do you own 20% to 50% of the investee's shares or voting rights? There are other circumstances for which you might exercise significant influence, such as if you're the primary supplier to the entity or the primary customer, you're able to exercise significant influence over operations. So you would be considered to have significant influence in this realm, and you'd be required to use the equity method. If you don't exercise significant influence over the investee, then you use the cost method. Next slide. All right, so here's the scenario of purchasing an entity and the difference between the cost method and the equity method. We're not getting into the consolidated method. I don't believe I've ever come across any captives that hold investments that they consolidate. But if you do, you can answer any questions that you may have. So in this scenario, it's the same facts. The only difference is the percentage of ownership of ABC Co. So the facts are that ABC Co. purchases 10% under the cost method and 30% under the equity method of XYZ Co. for $1 million. At the end of the year, XYZ Co. had earnings of $2 million and distributes a dividend of $400,000 to its shareholders. At the end of the year, XYZ Co.'s market valuation is $10.5 million. So when ABC Co. purchases the investment under both the cost and the equity method, you record the investment at cost by debiting an investment account and crediting cash. At the end of the year, ABC Co. receives its proportionate share of the $400,000 dividend. So under the cost method, you own 10%, so you get $40,000, which you record as dividend revenue. And under the equity method, you own 30%, which you record as a credit to your investments because it's not revenue, but it's treated as a return on investment. Then at the end of the year, ABC Co. recognizes its proportionate share of XYZ Co.'s earnings. Under the cost method, you don't recognize anything because you're carrying the investment at cost. Under the equity method, you would recognize investment revenue and you would debit your investment in the company because you're not receiving any money at that point. Under both methods, you're required to evaluate for impairment at the end of the year. The market valuation has gone up from when they purchased, so ABC Co. has determined that no impairment has occurred, thus no entry is required at this point. Next slide. So now we'll go into the key differences in how to present on the face of the financial statements and in the footnotes. On the balance sheet, they'll be presented the same, investment in whatever company you are investing in. On the income statement, under the cost method, as you receive dividends, you recognize revenue. Under the equity method, you recognize revenue as the company earns the revenue. You would recognize your proportionate share of their net income. Under both the cost and equity method, once you sell the investment, you would recognize your gain or loss on sale in the income statement. On the cash flow statement, it's very similar. The purchase goes under the investing section for both the cost and the equity method. Dividend revenue is recognized in net income in the operating section, and the investment revenue is included in net income in the operating section for the equity method. Under both methods, you're going to have your gain/loss removed from the operating section, and the amount that you received is going to be included in the investing section. Under the cost method, this gain/loss will be more significant because you're not recognizing your proportionate share of earnings as you go throughout the investment. Then an additional item under the equity method is dividends. Because it's a return on investment, it's included in the investing section. Next slide. All right, then getting into disclosures. Cost method is pretty simple. You just need to disclose the aggregate carrying amount of all cost method investments that you hold. And then if you have not evaluated any for impairment, you need to disclose that fact and which companies you have not evaluated for impairment. Under the equity method, you primarily need to disclose key information for users so they can understand what your investment is. So you present the name of each investee and percentage of ownership of common stock, if significant, the accounting policies of the investor relative to the investments in the investee's common stock, differences, if any, between the amount at which the investment is carried and the amount of underlying equity and net assets for the latest balance sheet presented, and the accounting treatment of that difference, the aggregate market value of each identified investment for which a market value is available. When investments in common stock, corporate joint ventures, or other investments accounted for under the equity method are in the aggregate material, disclosure includes summarized information as to assets, liability, and results of operations, either individually or in groups as appropriate. And then you need to disclose material effects of possible conversions, exercises, or contingent issuances of the investee. If the investee plans to issue more stock, you need to disclose what effect that has on your percentage, and if that changes, what kind of method you're going to be using going forward. You also need to disclose investments in common stock that are shown on the balance sheet should be presented as one item, as well as in the income statement. You should have one item for revenue from those investments, and then, like Diane showed in the disclosures, you would break out the individual investments that you've made and the revenue that you've recognized from each. And lastly, if you have an investment for which you own less than 20% of the shares, but you're accounting for it as an equity method investment, you need to disclose why you deemed equity method the appropriate accounting for that. And vice versa, if you own greater than 20%, but you're using the cost method, you need to disclose why you think it's appropriate to account for that under the cost method. Next slide. That's our third polling question. Which method is most common among your clients? The consolidation method, equity, cost method, or your clients don't carry alternative investments? Okay, I think we can close it now. Great, yeah, the majority will be either cost method or not carrying alternative investments. And here we don't have any that are using consolidated. Great. Do we have any questions at this point related to alternative investments? I didn't see any come through on the Q&A.
Yeah, we don't have any at this point on the Q&A. So thank you very much, Tanner. And again, like Tanner mentioned, if you have questions that you think about, you can, encounter a situation with one of your clients, you can always reach out and we're happy to brainstorm with you on which method is best there. So with that, now we get to hear from a tax manager, Jason Parker. So we're switching it up on you. I'll turn the time over to Jason.
Thanks, Diane. Yes. Now I'll move away from financial accounting and reporting, and we will talk about some IRS forms. So everyone get excited. So in 2015, the PATH Act created a problem. It created a number of challenges, but one problem that the PATH Act created was that it changed it made the due date for Form 1099 MISC if there was an amount in Box 7, January 31st, whereas Forms 1099 MISC with no amount in Box 7 were due February 28th or March 31st if filing electronically. And Box 7 was non-employee compensation. So if you filed a batch of Forms 1099 MISC with some with amounts in Box 7 and some without, then if you filed it after January 31st, the IRS could potentially erroneously assess penalties on the whole batch instead of just those that were late. And so the IRS revived an old form, Form 1099 NEC, which stands for non-employee compensation. This form, I say revived, they used it back in 1982 and before that. And so now they're using it again, and it's solely used to report non-employee compensation. You can see there, Box 1 is basically the only box to report a payment. The left side is obviously the payer and recipient information. And then boxes 4 through 7 are for federal or state withholding information. Next slide, please. So we saw a look at the Form 1099 NEC. Here where we can see the 2019 Form 1099 MISC and the new Form 1099 MISC for 2020. The only difference is that the IRS took out Box 7, which was previously used to report non-employee compensation, and they rearranged some other boxes. It's all geographical changes. This form is still used for payments made for rent, royalties, fishing boat proceeds, which I hope to see sometime in my career, and other things that you typically use 1099 MISC for. Next slide. So let's talk about the types of payments for which you'll need to use Form 1099 NEC. Similar to Form 1099 MISC, this is only used for payments made in the course of your business. So it's not used for any personal payments, but you use Form 1099 NEC for each person in the course of your business to whom you paid any of the following types of payments during the year. And this is from the form instructions on the IRS website. So that'll be a good resource when you are completing Form 1099 NEC. So you use it for payments that are at least $600 in services performed by someone who is not your employee. or payments to an attorney. The interesting thing to note here is that when you pay attorney's fees, you use box 1 and on form 1099 NEC. If you pay an attorney any other type of payments, like for a settlement or any other payments, then you use box 10 on form 1099 MISC. But I'm assuming a lot of your captive clients will be paying attorneys, and so you'll paying an attorney's fees, so you'll use 1099 NEC. Also, you use form 1099 NEC for any cash payments for purchasing fish or other aquatic life, but I don't think your clients will use that. So the other thing to note is if you ever have federal income tax withheld under the backup withholding rules that you have to report, then you need to report it on form 1099 NEC, regardless of the amount of the payment. So even if it's under $600. And also, similar to form 1099 MISC, there are some exceptions when you don't need to report. You generally don't need to report any payments to a corporation. This includes an LLC treated as a C or S corp. And however, for attorney's fees, even if you pay an attorney who is incorporated, then you do need to still report on form 1099 NEC. There are a few other cases in which you need to report payments to a corporation, but I don't think those will apply to you either. So let's go next slide, please. And we talk about some of the due dates here. Form 1099 NEC and Form 1099 MISC need to be distributed to recipients by January 31st. For Form 1099 NEC, you need to file it with the IRS by January 31st also, whether you are filing by paper or electronically. But the due date hasn't changed for Form 1099 MISC. You need to file that with the IRS by February 28th if filing by paper, or by March 31st if filing electronically. And for either form, if you are going to be filing more than 100 forms, then you have to file them electronically. Next slide. One last thing to note about Form 1099 NEC is that Publication 1220 indicated that Form 1099 NEC will not be part of the combined federal state filing program. This means that you'll need to keep track of state filing requirements separately. This link I've included hopefully will be helpful in tracking the different state requirements, but some states will require that you file Form 1099 NEC information with them all the time. Some states will require it only if there's state withholding for being reported, and others won't require it at all. So that's another thing to keep in mind. Next slide, please, is our polling question. So when does Form 1099 NEC need to be filed with the IRS? By January 31st, February 28th, March 31st, or April 15th? All right, good job. Remember that deadline so you can distribute it and file it with the IRS by January 31st. And I believe that's the end. So now we'll open it up to any questions that anyone has about anything we've talked about.
Thanks so much, Jason. That was very informative, especially for a non-tax person such as myself. Now, if a client calls me and asks me a question about that new form, I'll be like, well, don't you remember back in 1982? I was 2 then, so. Awesome. Thank you, everyone. And like you say, if there were questions that you have that we weren't, either you haven't asked yet or that we weren't able to respond to yet, feel free to put those into the Q&A. I am so sad that I didn't get to see all my friends in Mesa in person at all this year. I was supposed to come in April and bring in some lunch and visit and chat with you guys, and that got canceled. And then we typically like to come out in October, and that almost got canceled. That got canceled, like Halloween almost got canceled, but so I'm sad we didn't get to see you all in person, and I'm excited for, we're excited to have people participating from all the offices of our techs in the United States. So again, we're really thankful to all of you for being here. We see any other questions that have come in? I don't see anything that's come in. Just a reminder, after the session's done, the recording will be available on our website, as will the slides from the presentation today. We will make those available on our website as well. You will receive an email with the links for the evaluation surveys for CPE purposes. And like I said, if you weren't able to click on those polling questions, don't worry about that. We got your participation logs, and those of you that answered the questions through Q&A, that's great. And so with that being said, and if there aren't any other questions coming in, we just want to say thanks again to all of you for being with us today. If you do come across any questions, we can answer. We're always here and available to help, and hope all of you are staying healthy and safe. So thanks again for being with us today.